All right, in this lesson, we're going to go through the accrued revenue examples. We're going to show you how accrued revenue works and what that journal entry is going to look like at the end of the day. So let's get started. What are we trying to do? Well, what we're trying to do is we're trying to accrue revenue that we've actually earned, but we haven't been paid for it yet. So in this example here, we see that our account looks like this. It has $2,000 in it right now, and it should have $3,000 in it. And so we have to make an adjustment. The gray area or the slash area here represents the adjustment that we are going to need to make. In this case, an $1,000 adjustment. So in accrued revenue, we are earning the revenues now, but cash is being received later on, typically, within the payment term. So 30 days, net 30, so on and so on. Okay. So as accrued revenue adjustment is made to book a revenue now and then book the cash receipt later on. So it looks something like this. The adjusted journal entry, we're going to debit what we're owed. So we're owed something. So we're going to debit accounts receivable, and then we're going to credit sales or service revenue because we've earned it. Then what happens is later on, we are going to receive the cash. So we'll debit cash because we're going to receive it. And then we're going to extinguish the customer's liability. In this case, the customer's liability would have been in the accounts receivable. So we no longer are receiving it. So we're going to do opposite of what we originally did. We originally debited, so we need to credit it for that amount. Now, again, remember that this amount right here, these two amounts here, doesn't have to be the same because a customer can pay a little bit at a time, therefore not extinguishing their entire debt. So it's important to know that. All right, so let's jump into an example of what that looks like. Walnut Creek's venue also has 50 acres of orange groves. It is the end of the orange harvesting season, and Walnut Creek sells 5,000 pounds of oranges to Baldwin Superstores for $2,500. Walnut Creek delivers the oranges to Baldwin's facility and issues an invoice for payment in the next 30 days. So what's happening? So right now, we're showing that revenue is $2,500. The question is, what should it be? Well, it should be $5,000. Why? Because we sold $2,500 of oranges to Baldwin Superstores, but we haven't collected the funds. Because we haven't collected the funds, we haven't actually done a journal entry. So at the end of the period, we're going to book an adjusting entry for the revenues that we have earned, regardless of whether or not we were paid or not. So in this case, we have an adjustment here. That adjustment is going to be $2,500. How do we get that? Well, what should the account be? The account should be $5,000. What is it currently at? It is currently at $2,500. So 5,000 minus 2,500 happens to be the same amount of $2,500. So let's look at what that journal entry is going to look like. So notice that we're going to start with the adjusting entry. In the last couple of lessons, we started with the original entry and then we did the adjustment. In this case, we're going to do it in reverse. So we start with the adjusting entry. What do we need to adjust? Well, we earned revenue. So increases in revenue are a credit. So we are going to go sales revenue for $2,500. And then what would our debit be? Well, normally our debit would be a cash, but we're not receiving the cash. We are basically telling Baldwin Superstores to pay us in 30 days. So instead, we are going to book an accounts receivable. So we're going to debit accounts receivable for $2,500. So that's what we would do there. Now, what would happen afterwards? Well, what would happen afterwards is we would collect the cash. So if we collect the cash, we're going to receive cash. So increases in cash is an asset. It's going to be a debit. So we'll debit cash for $2,500. And then we're going to credit the extinguishment of the amount owed by our customers. In this case, the accounts receivable. So accounts receivable for $2,500. So that's what our journal entry would look like. So let's see how all of this would impact our T account. So notice that our sales revenues was at $2,500. Because of our adjusting entry, we need to book another $2,500. So in this case, $2,500, that would give us $5,000 as our ending balance. What about accounts receivable? Well, our accounts receivable, we credited $2,500. We debited $2,500. So that would give us $3,000 as an ending balance. But we did receive our $2,500 in another period. So in that case, when we do, we'll credit that $2,500 and that would get us back to $500. And again, you don't have to go all through that way, but I want to show you kind of how it works. Notice that our adjusting entry, cash was not debited, cash was not credited. Remember, adjusting entries do not impact cash. Only the after effect or the before effect if cash was paid before or after. So that's what that entry would look like. So that is a look at the accrued revenue example. I hope you enjoyed this lesson and got an understanding of how we would book that, and we will see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.